All right, everybody, welcome in to our May market commentary. We're gonna give everybody a couple minutes to join in here, but appreciate you guys joining us. We're doing this one a little bit different today. We haven't done a live webinar in some time, or at least not on Zoom. We've been doing them on YouTube, and we found it's just not quite as easy for the Q&A portion of things. So we're still going to do most of them on Zoom going forward, but with everything going on right now, just wanted to make sure we had a good format for a Q&A session, make sure we get every everything answered that's on your guys' minds. So we've got a good number of people joining in. We'll be going through a quick market commentary today, but so we'll have a short presentation here at the beginning, but then the idea is that we're leaving plenty of time at the end for questions. You know, if you're a client of ours, you know it's something you can always reach out and ask us about. We've been trying to post a lot more on our YouTube page these days. We've been trying to get a lot of articles out and things like that to stay in front of things and emails and whatnot, but sometimes there's nothing like just asking a question and talking like this. So anyway, I think that's enough. We can go and get started. I see the numbers joining in or slowing down a bit. So just introductions, right? My name's Austin Costello. I'm joined by Evan, and we had a last minute addition. Neil joined in, and I already see questions coming into the Q&A box about the baby, Neil. So I think we need an update on baby.
Okay, that sounds good. I got a whole presentation put around the baby for today. And if we have time, I might just enter in the baby into my office so we can get a nice glimpse at her.
Simba the baby on the Zoom.
I'll do it. Don't tempt me. My
All
wife
right, Neil.
will.
So baby's name.
Baby's name is Kennedy Kane. She was born last week on Tuesday, so she's 9 days old. She's healthy. She's amazing. She's really, really cute. Uh, she won't sleep through the night, but we that's to be expected. So we've had some decent nights, some rougher nights, but last night was okay. So that's why I decided, hey, you know what? I'll join you two on this. I feel I feel pretty decently rested.
And I don't know if we have
Yeah,
ever done a webinar with all three of us on it.
I
Maybe
don't
one
think
time.
so.
Maybe one time. But this will be good. So before we jump in, and there will be more time for baby talk at the end here. But before we jump in, just wanted to say we'll be using the Q&A box. Um, Again, we're going to be doing a short presentation here. Just know the questions that you ask do not have to be related to the presentation. Okay. The goal of this whole thing was to get some questions answered just about anything. There's a lot going on right now. There's all these um, deferred resignation programs and Vera offers and VSIP and all these things that are being thrown at you guys right now, especially and then we got the market uh, doing whatever it's doing. And we'll have some commentary on that. But if you have questions on anything that's going on right now, go ahead and type those in the Q&A box. As we're going, as long as you're thinking of these things, we'll get to them at the end. Okay, so we got a short presentation here first, and then we'll get to all those questions that you guys here have at the end. So what are we going to be going through today? We'll have a quick chat on the stock market, quick chat on the bond market, and then we'll get to these questions. So let's jump right in. What is going on with the stock market these days? It seems like every day is a swing one direction or the other. But what's the trend that we've seen so far this year? Well, the big one, and if you've been keeping tabs on these presentations we've been doing, if you've been watching them on YouTube or watching them live with us, and you've noticed that over the last year and a half or so, there's been a theme whenever we talk about the market. And that theme has been, man, these large tech companies sure do seem overvalued at this point, right? We've seen a lot of growth in that sector, and we just weren't sure how sustainable that has been. And we've been preaching diversify, diversify. Don't just follow the trend. Make sure you're still spread out. we're starting to see some of the reasons for that play out. Okay, so this year we've seen tariffs hit the market. We've seen some economic uncertainty. There's some questions about what's going to happen with inflation. And so we've seen that hit a couple areas of the market the hardest. One has been that large growth sector, those big tech companies. The other, and this has more so been something caused by the tariffs, has been the small companies have really been impacted here. So when we break the market into large companies, mid-sized companies, small companies, and then value and growth, we'll talk about that more in a second, we can see how they're spread out here. And over the last year to date, the growth segment of the market and then the small company segment of the market have been hit the hardest. Now, on the growth side, part of that has been, chip related. Okay, there's a lot of artificial intelligence, a lot of technology, there's chips coming from China and Taiwan, and understanding how tariffs are going to impact those. But the small company of the market has really been hit by tariff, or the small side of the market has really been hit by tariffs, because when you think about those companies, a lot of them are product oriented. They're selling goods. And when it's a smaller company, they're selling goods, the impact that those tariffs have are much stronger. And there's a lot of uncertainty around how that's going to play out. So you can see year to date where we're getting hit. And as we elaborate on a few of those things, there's been part of the market through this all has been pretty resilient. Or part of the US market anyway. The part that's been the most resilient has been the US large value. So these are the companies, when we think of large value companies, we're thinking about Procter & Gamble, Home Depot, Costco. These are the large established companies. They're not trading at super high valuations. This is the side of the market that typically in recessions is more resilient because they have a more of a defined cash flow situation. They're not as dependent on growth and earnings. So we've seen the large value side of the market hold up really well. Again, we've seen tech and small companies be hit the hardest, and you can see those have really coincided here with some of these tariff announcements, right? It's really been driving those segments of the market down. Now, another thing we've been noticing this year is that there has been some value in international markets. Okay, so you'll see in red here, this is developed international markets. Okay, over 5% this year. There's been emerging markets. So these are, India, China, Korea, places that are less developed countries, but still large investment markets. And then there's US here, and both emerging and developed markets have been outperforming the US this year. Now, we're going to tie this all in. I know a lot of you guys are in the TSP or have been in the TSP in the past, and you're saying, well, what the heck? Everybody's always told me to avoid the I fund, right? The I fund is the international markets. Everybody's always said avoid that. And now this year, all of a sudden, it's doing better. Well, there's a conversation to be had around that, right? First of all, there's a lot of fear surrounding the US right now with this administration and the tariffs and all of that. We're yet to see how that all plays out. Two, we have never been in the camp that international markets are a bad place to be. We don't necessarily want that to be the majority of your portfolio, but also the thing that's kind of held back the I fund in the TSP is the fact that it's such a broad index, and it has consistent exposure to such a large swath of the international market, that it doesn't really benefit from the pieces of the international market that are doing well sometimes, and gets held back by others. So like in the portfolios that we're managing, we use what would be considered an actively managed international fund. And we don't have that plotted out here, but one of the benefits of that is there's a manager on that fund who can pick the better parts of the international market and kind of avoid the parts that are experiencing conflict and things like that. So this is just to point out the trend. What we're absolutely not saying with any of this, right, is go ahead and ditch the C fund and swap it to the I fund, right? That is, don't hear that at all. We're just saying right now, with all of this happening, there's been this changing of the guard, at least for the beginning of the year, where the international market is showing some value. And so the point of all this, and I know we're very high level here, right? This isn't meant to, we want this to be a high level view of things, and then we'll go ahead and answer some questions here. But what we're finally seeing is that there's a benefit to being diversified in your portfolio. Over these last couple of years, there has been no benefit to being diversified. It's been C fund or bust, right?
Yeah.
It's the C fund is just it was driving the market in a way that if you had a diversified portfolio, you felt like you were being left behind. Finally, we're seeing some value here to having bonds in the portfolio, to having some international exposure, to having some value and growth. And so we're really, this is the whole point of having a diversified portfolio, and we're finally seeing that kind of pay off for us. So kudos to those of you who have been following that strategy, and hopefully you're able to sleep a little better at night, seeing that while the S&P 500 is down over 8%, a diversified portfolio is not down at all year to date, right? So if you're set up that way, you don't have to lose sleep at night, on the news of what happens to the S&P every day.
Yeah, it's so interesting. We see news updates every day. The markets are swinging like crazy. We had one of the worst 4-day returns in history. And all that being said, a diversified portfolio could still be pretty close to even on the year. But one of the worst 4 days returns we've seen in history was when the tariffs were announced. And the other worst 4 days were big events like Black Monday, COVID, the Great Recession, where we've seen terrible 4-day returns before. But when we look at the 12-month forward return, where we had the terrible 4-day return, and then we look 12 months out from there, the average return after that downturn is 30%. So you'd actually be higher than where you were than after the correction. So that's just really interesting that, and it's also not totally surprising that some of the best days happen after the worst days. And if you do miss some of those best days, your returns are significantly impacted. So just to mention that the 50 best days in market history, 50% of those came during a bear market, where we can only get those really, really good days during those bad times. And let's say that you were the absolute worst investor in the world, and you took all your funds and moved it to cash on a great day, one of the best days, and you did that 10 times over the last 30 years. So you're investing in the S&P, you sell out, move to cash, and there's a best day, and that happens 10 times. What happens to your returns? Let's say that you invested 10,000 in 1995. If you were fully invested in the stock market the whole time, you would have gotten 225,000. If you missed those 10 best days, your returns would be half, where it'd go from 225,000 to 100,000. Just by missing 10 days in 30 years, your returns would be half. Pretty stark difference there.
Yeah, and well, just to relate that back to what you said before, it's not just missing the best days, but this is kind of a thing that people do, right? They experience a really bad day, and then they pull out because they experienced the bad day. And then that's when the good day happens, right? So it's not just that, oh, this is a dumb decision, you just happen to miss these bad days. It's that you reacted to the bad day, which then makes you miss the good day on the other side.
Often very
And
close together.
yeah.
And we can see that here, where these are the biggest swings in the market in history. And starting at the bottom, we can see what added to that worst 4-day return. There was a big negative return in 2025. Is that cut off?
It's almost 6%. Is that the one you were
So there
referring
was a
to?
day of minus 6%. There was another big loss during that big 4-day drop that added to the 12. And then if we go a couple of days out after there, on April 9th, there was actually almost a double-digit day in one day. So that just goes to show that the absolute best days in the market tend to follow some of the worst times. And the reason that we use our bucket strategy is because if we look at the 7-year holding period, if we look back in the total history of the S&P 500, there's almost a 90% chance of a positive return over those 7 years. So this is just going to show that for our funds that are geared for long-term goals, things that we don't need in the next 7 years, you're supposed to weather the storm because the best days do follow the worst days. And it's also interesting that even with a 3-year holding period, there's almost an 80% chance that you'll have positive returns as well. Kind of a interesting fact.
Yeah, and just a reminder, since I'm controlling the drawing tools here, the bucket strategy, right, is for those of you who, are maybe new to some of these presentations or are not clients on here. The bucket strategy, just as a reminder, is a way of preparing for investment withdrawals where we keep about 1 to 3 years of distribution needs in completely liquid, not market-oriented investments. It's in cash, CDs, money markets, things like that. And so when you look at this, right, if you've got 3 years worth of money in cash, that it doesn't matter what happens to the market, there's an 80% chance that the rest of this money now is going to be positive by the time you need it. Then in the second bucket, we have this 4 to 6 year category, and this is where we typically have bonds or some sort of semi-protected investment that also isn't fully in the market. Okay, so if you have another 4 to 6 years here, now we get up to this 85-90% chance that by the time you finally need this bucket here, which is your stock money, that has gone positive. Okay, so this is how we plan for distribution planning. For those of you that are not clients of ours that are on this call, when Evan mentioned the bucket strategy there, I just wanted to outline what that was since we didn't we tried to throw a slide in at the end and didn't get it in there.
What a powerful chart. I
Yeah.
mean, shows exactly the percentage chances of making money and why it would make sense, for that bucket strategy because, after beyond, let's say the 7-year period, you're at what, almost a 90% success rate on making money on putting that money away for a long-term perspective. So very powerful.
Yeah, and
Great
I don't
chart.
know if we'll get this question, but a lot of times, Evan and I were talking before this, and we just a lot of times when we talk about market performance and market downturns, we have people that are in retirement, right? Like many of you on the call probably are or are close. And the thought process is, well, if something like 2008 happens, I just don't have time to make it back, right? I don't have time to earn that money back. That's the thought process. And in reality, 2008 from the top of the market in 07 down to the bottom in 09, back to where you would have made your money back again, took less than 6 years. So unless you're saying you're 85 years old right now, which, hey, maybe we got some 85-year-olds on the call today. But the reality is that most of you do have time to make the money back, right? If something like that were to happen, we just have to be realistic about these timelines and what the market's done. So anyway, we're not anticipating or hoping or expecting anything like 2008 happens again, but just to put that in perspective. So we got a couple slides here on the bond markets before we get into the Q&A. I see some great questions coming in already. So again, type those questions in. They don't have to be related to what we are talking about right now. We really want most of this meeting to be kind of a Q&A session on whatever you guys find or helpful. So type those questions in the Q&A box. So, bonds are talked about much less frequently than stocks. They're just boring, right? Nobody likes to talk about bonds. They're harder to understand. We don't track the bond index like we do with the S&P 500 but they serve a really important piece of a diversified portfolio, as we were showing before. And they actually have the ability to be a ballast in down markets. And we want to spend some time talking about this because there's a lot of fear related to bonds right now because we just went through a couple years ago, 2022, 2023, where bonds performed very poorly. And that scared a lot of people who are more conservative. So we want to do some myth busting here with bonds. All right. So one, bonds year to date, the S&P 500 is down almost 9%. Bonds are up 4.6, right? Long-term bonds. Okay, you go midterm, almost 4%. So you're making money on bonds right now. If you look over the last year, bond funds like the F fund and the TSP are up almost 8%. Now, 3 years, we're still seeing some of the residual impact of the interest rates rising back in 2021, 2022. Okay. Now, let's pull this up. There's a lot going on in this chart, but it's really helpful if you're able to discern and understand this. Okay. So what we have shown here is in blue. This is the one that when you hear about, okay, the Fed raised rates, or the Fed's cut rates, or Jerome Powell did this, or Jerome Powell did that. This is what we're talking about, right? This blue line that stair steps like this and then stays steady and then now has started to come down. This is the Fed funds rate. This is effectively the shortest term interest rate that you can have. It's like what banks historically have loaned money back and forth to each other. It's not really how it's used anymore, but this is really short-term interest rates. This is what the Fed sets. Every other bond, whether it's a treasury bond or a corporate bond, is based then on that. Okay. But the longer you go out on a bond, okay, so there's bonds of all different lengths. There's 2-year bonds, 5-year, 10-year, 30-year. Okay. The longer time frame a bond is issued, the less it is tied to that short-term federal rate. Okay. And that it kind of makes sense when you think about it, right? If you're buying a house and they're going to lend you money, they don't care what the Fed's going to do this month or next month. They want to know where rates are going to be over the next 10 years because that's what you're going to have to be paying, right? Over that long period of time. And so there's this disconnect that happens between the Fed is lowering rates and people are going, great, my mortgage is going to drop. No, not so much because they're not connected, right? Like mortgages and a lot of consumer debt are tied to the 10-year treasury, okay? Now, we can see what's been happening here, and this is really interesting, right? Okay, so we got to kind of last year, and we started to see inflation come down between, 2-3%. That's where the Fed really wants it. They wanted it to. And so they started cutting rates. But at that same time, we started to get election results back. We started thinking tariffs were going to happen, and people got nervous that inflation was going to happen again. And we know now when inflation happens, interest rates go up, right? And so because there was these nerves about inflation maybe happening in the future, what happened is the 10-year treasury and even the 2-year started rising at the same time that the federal funds rate was falling. So there was this disconnect happening where the Fed says, okay, we see inflation falling, we're going to lower rates. But then this news comes out and the market gets concerned and they say, well, we think inflation is going to go back up. So rates start coming up, even though, so there's this difference between what the market sees and what the Fed's seeing. Now we're finally starting to see things kind of normalize, and whatever happens in these next few years is going to determine more, or in this next year or two is going to determine the long-term direction. Can this 10-year treasury actually continue going down if it's proved that tariffs don't dramatically spike inflation? So again, there's a lot going on here, but all of that is going to drive the direction that we see in the future. It's not just this Fed funds rate that you hear about on the news that determines all this. Okay. And then we can come back to that one in a second, but we'll just kind of wrap up in here. And Evan, you want to talk about this real quickly?
Yeah, going back to 2022, that was a really bad time for bonds because if you can go back to that last chart, Austin, two ago, we saw the Fed fund rate go from essentially 0 to 5%. And we know that there's an inverse relationship between interest rate and bonds, meaning if interest rates are going up, the value of bonds is coming down. So that makes sense in 2022. Yes, the Fed's fund rate increased, which in turn means that bonds performed very bad. And another thing to mention there is we went from 0, let's call it 1 to 5, that's a 5 times higher interest rate. It didn't double, it went up by 5 times. So people are really worried about inflation right now, and rightfully so. We're keeping an eye on it. But something to mention here is that the Fed fund rate is, call it 5% right now. If it doubles to 10, that's not as bad as going from 5% to 25%, which would be closer to a situation that happened in 2022.
Yeah, and what's interesting is Evan and I were even talking before this, and we're like, because we're looking back at the 70s and 80s, and we're like, rates were climbing then. How did they avoid this big fall in the bond market? And the answer is from like 77 to 81-ish, late 70s to early 80s. Interest rates went from 7% to 15%. The 10-year treasury went from 7% to 15%. But it happened in about 2% per year increments. It didn't go from 0 to 5 in 1 year. It happened in 2% per year increments, so the market had time to adjust to those as it was happening. Additionally, interest rates were already starting at a higher place, so even though bonds were kind of losing value, you were still getting a 7% return off your bond or an 8% return off your bond. So that goes a long way in balancing things out. And that's a big difference now between where we are now and where we were before, is like now our bonds are paying us 4.5, 5.5%. So even if they lose some value, at least we're getting 5% off that, right? And that goes a long way to, sorry, Neil,
The risk, it's a great point. The risk for bonds is way less than it was just 2 years ago, because you're starting with a much higher yield. So even if you get, like you said, that a depreciation because of an increase on interest rates of 1% or two, you're getting 4.5, 5 in some cases of interest rate on to offset that loss. And that's a great point that you circle back to the 80s, because rates were extremely high then. How did they avoid losses? You got to start with a decent yield to avoid the loss, which is, we're at historically high yields for the last 20 years in bonds right now. Best probably yields we've seen in 20 years.
yeah, absolutely. So again, like we said, we didn't want to take too much time on that. I know we still spent 20 minutes or so on the market commentary, but now we got plenty of time for questions here. Before we get into that though, we show these every time. They never become less important, right? Strategies for investors. What's important here to keep in mind? This is more important now than ever. Don't let your emotions drive your decisions. Worst thing you can do. Understand your risk tolerance. If what's been happening in the market right now has you really scared, you might be doing something wrong, right? Like that, what's happening right now, like we've only seen the market's only down 9%. Like this is normal for a market, right? So if this has you scared, we need to think about your plan and understand that we need to make sure you're within your risk tolerance here, because this is normal. We need to know the time horizon on your funds. This goes with risk tolerance. When are you going to need it, right? And we need to make sure you have enough set aside with that bucket strategy so that you don't care what's going on right now, because you know you've got 3 years, 6 years worth of distributions in safe money. Be diversified, more important now than ever. Stay invested, right? So these are reminders every time, never more important than they are right now. All right. So we're going to get into the Q&A. Just know, for those of you on this call, I know most of you that I'm seeing put questions in are clients of ours. If you're on this call and you're not a client, we do have a free financial checkup that we offer. So this is a free call with one of us 3 advisors or one of our financial coaches. And we can talk about any of these questions that you have that are more personal to you. So I'll leave this up in case you're interested. You can go to retfed.com/register. Also, this whole Q&A will be posted on our YouTube channel. So if you missed the first part of it, we're recording this. It'll go on our YouTube channel. Go find it there. Capital Financial Planners on YouTube. We also have lots of other information there. So without further ado, let's answer some questions. Neil, since you jumped on this call kind of last minute, is there anything that you wanted to add to what we've talked about before, or any commentary from you?
Just a commentary on our investment portfolio. So heading into the year, we thought that this could be a volatile year. We reduced equity exposure down by 10% into a hedge position. We are overweight value right now, and we've been that case going into the year. We just initiated actually our first designated small cap position. We got the S fund as well as small cap in general, as was shown on the slide, couple slides that you have, was one of the most punished areas in the market and is actually very undervalued compared to large cap right now, especially large cap growth. So even though large cap growth got punished, we're not buying more of it right now. These are the speculative kind of more technology based because of the actual valuation of that side. But small cap got punished and is trading at historically low price to earnings ratio. That was a good pickup. So we bought and initiated the Invesco small cap value position, not on the growth. Other than that, right, we've kept kind of our bonds in place. We're overweight treasuries. We've initiated in the last 6 months the Osterwise Strategic Income, which has 30% cash in that fund. We like their flexibility. But right now, I guess it's safe to say that we're in a defensive posture. We're actually looking for a bigger pullback from the market to take our 10% hedge off. So as crazy as that sounds, we'd like the market to actually come down some so we could profit from that. I know that that sounds to some of our investors what you don't want to see on your statements, but that's how money is made. We also upticked our international exposure this year. So across our equity portfolio, we have 14% international now. And we're just sticking to the high quality, high revenue generating areas of the market as opposed to that growth side. So just wanted to give people a little bit of a background on our own investment thesis. Obviously, we operate outside of the TSP when we make these changes. But a lot of that can translate over to the rationale that you have in your TSPs as well. So with that, I did answer some questions that were related to like federal benefits and stuff, gave some article links. If that didn't answer your question, please feel free to chime again so that we can answer it live. But I wanted to get that out in the open before we start taking more of the market tariff related questions that I'm seeing more of a theme of here. So I want to start with the first question that we have with Jim Dobson.
Yeah.
I guess I'll state the question and then we can kind of figure out who wants to give a shot at this. So Jim Dobson asked, when the tariffs hit the marketplace in May/June, what will happen to the stock market and bonds?
Evan, you want to swing at that one?
Yeah. So the stock market is already pricing a lot of these things in. So could we see something happen, whether it goes up or goes down even more? Yes. But the idea is the stock market is already trying to price what's going to happen in a couple of months.
Yeah, the hard thing about it too is that as we've seen, things that have been announced that are going to go into place haven't, and then things that haven't been announced have been more so. So to predict that is hard, but I would say right now the market is probably pessimistic, thinking that things are going to be tougher than they are, just because that's what we've seen so far. And so I would say that probably I would assume most of the worst is priced in. But of course it's hard to predict that completely.
And I'll take my shot, and I don't have any
Proprietary knowledge.
making abilities, but I think it's going to be a volatile summer. There's a lot of, there's a lot of things moving right now in the market, which is why we did not release our hedge. Markets almost got down 20%, and us three were circling around talking, do we release that 10% hedge that we came into the year with? We did not. And the reason is because we predict, right, that these issues aren't going to be resolved right away. I mean, yes, the president could tweet this, that, or the other, right? But at the end of the day, we think it's going to be more of a longer process. And as we head into summer months, we expect more volatility. We expect bonds to really to address your question, Jim. We expect bonds to do their part in your portfolio, to keep that portfolio anchored. There will be some headlines about the bond market having issues, but we still believe that the US bond market is the strongest bond market in the world. There's been rufflings. Could the bond market be broken? Could there be issues in the bond market? We've been having these comments, right, for decades. You could go back to the 70s, to the 80s, when yields shot up. Is the bond market broken? Is the US Treasury markets going to be a poor place to invest? And the answer really is in number one, the safety, number two, the yield. So what other countries are safer places for you to store your dollars in a safer way? We could look at a very financially responsible country like Germany. Germany has historically ran very good balance sheets, right? They don't spend more than they take in. They actually spend very little than they actually bring in as a country, and they've been very financially responsible. That would be a great thought. Okay, I'm going to park my money in Germany. So let's play out the scenario. I'm China. I want to punish the US by taking the $700 billion that I invested in the US Treasury market to affect the bond market in the United States by punishing them for this tariff. Okay, so I'm going to take that out, and I am going to then put that into another country that I deem stable in their bond market. Let's pick Germany. Well, the problem with that is Germany's bond, I think that's what it's called, the German bond, right, yields 2.5% or lower. So I'm going to take money out of a stable country, a safe bond market like the US, arguably the safest, and take that out when it's yielding 4.5% and park it in at 2.5%? Or am I going to take that to Japan where it's 1%? The problem is there's really nowhere else to go for a decent yield from a safe country. And yes, the theory is that everyone could pull out a U.S. Treasury, but where else are you going to go? And that's why we still believe that the U.S. bond market treasuries are still going to be the most stable place to park your money. So a long-winded answer to your question, Jim, is yeah, those bonds will hold up. Yes, could there be some shocks to inflation scares and things like that, but at a starting yield at 4.5%, even if there's a slight volatility in that bond market over the summer months, we still think it's going to produce positive returns. And that's what we've seen this year. And we think that that investors should maintain and hold those bonds.
Yep.
Okay.
I'll jump to the. Oh, what was that?
Yeah. No, I think the second part of his question was about tariffs on stocks. I think there's plenty of questions that we could get into stocks, but as we go through. So why don't you go to Karen?
Yeah, I was just gonna read Karen's here, and so and this is a good one, Karen. I knew this was gonna be a question. So just speaking of wild market swings, during the past economic shocks and downturns, we try to focus on the advice to stay the course. And long term in the market always rebounds. But this time, it makes us wonder if there's more risk of structural changes, what that are changing, if, when, and how the market can rebound. When you get to the questions, can you talk about not just the market action reaction, but if or how there are changes to rules, policies, laws, treaties, etc., that will change to affect the market longer term? So it's a great question, Karen. The 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 first thing I'll say to this, and Evan and Neil might chip in here, is that the 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 biggest stressor right now is the unknown of it all. Like, once things are established, say there are 100% tariffs on China, right? Say there are. Well, then the market will adjust, and more things will be made in Vietnam, in Korea, in other places around the world, and in places that we'll eventually negotiate with. Say there are changes to treaties. Well, then we'll adjust, and businesses will do business in a different way, right? What's really difficult about right now is that there's no time to adjust to anything. All of a sudden, there's a 150% tariff on China that's impacting business now, but for a company to go change their whole supply chain, they can't do that overnight. So it's spiking prices and it's causing turbulence. I think the big picture is that the market will adjust to wherever we wind up here. Whether that means potentially slower growth or faster growth is really difficult to know. But the market will adjust, and we have to remember what we're investing in. We're investing in these real US companies that are making real things, that are successful, they're innovative. I still believe the US is, the best, if, not one of the best, if not the best place to have a business and to innovate and grow. And so we're investing in people that are innovating, growing, and if we're betting against the market, we're betting against innovation and growth. I think the biggest thing to think about is, how does this even out, and do we give does this administration finally land on something and give people time to then react to it? Because that's really, I think, the answer about what needs to happen going forward.
Yeah, and just to build on that, there are some companies that are going to be affected more than others. Like when you look at Netflix, like they're not really going to be affected by the tariffs too much, and they're one of the biggest holdings in the S&P 500. And companies that are going to be affected a little bit more, where we know that they're importing a lot of goods from China, we've seen their valuation already be corrected significantly. So going back to some of these things are priced in, and then companies are going to be adaptable. When the tariffs do kick in, they'll find different ways to innovate and grow.
Yeah. Neil, anything to add to that one, or should we move to the next one?
You move to the next one.
And there's a couple questions kind of similar to this next one. And so I think we maybe address some of these around at the same time. So this next one is from an anonymous person. It says, so if we currently have more risk, C fund focused, and we're going to retire in a few months, use the TSP maybe in 3 to 5 years, when should we rebalance to be more diversified? It seems like now is a bad time, because transitioning from C fund to something like L2030 would seem to be losing value. Evan, you want to take a shot at this one? I'll see if there's any others that fit that bill.
Yeah, this one is a little tricky because I think it really depends on the cash flow needs. Where if we really need some funds that are safe in cash, we really need them for the next couple of years, I would say, yeah, it might not be the best time to do that, but it might make sense for safety and security reasons. If these are more of a long-term bucket, maybe we wait for a little bit of a better time to rebalance than right now, because it seems like losing to me too.
Yeah, I just wanted to go back to this chart here real quick. So I think any of these questions, and there's a handful on here that are about when does it make sense to reallocate. I'm aggressive now, but I'm out of a job. now, in a couple months because I got rift, or I'm planning to retire in a couple months. The way that we make investment allocation decisions is with this bucket strategy. Okay, like if you were to come into a financial checkup meeting and talk with us and say, how should I be invested? This is the approach we would use. And we would say, if you know you're going to need money in 1 to 3 years, that money really should not be in the C fund. It shouldn't be in the I fund, shouldn't be in the S fund. Um, it should be in something like the G or the F, probably. Right? Probably more so G fund, honestly, for 1 to 3 years. For 4 to 6 years, that's more like F fund money. Okay. So this isn't a perfect science, but you have to go through, when am I going to need money from the portfolio? How much am I going to need? And then this is the exercise you go through to decide how much you need in which fund. And like Evan was saying, yeah, you might have missed the top of the market, but the market's still up 9% over the last 12 months. Like when you zoom that back out to the early 2000s, like we're up like 350% since the mid 2000s. So like, sure, maybe you didn't hit it exactly right, but really in the grand scheme of things, we're sitting at a really nice, place in the market right now. And what you really don't want is to need money in 2 years from now and have your account be 25% less than it is now, which is, the place that if the 2008 were to happen. And so, um, again, these types of questions are really difficult to answer in an exact way on a call like this. I would recommend, setting up one of our financial checkups if you have a more specific question like this, but that bucket strategy is the way that we go about it. And so to answer this in a pretty straightforward way, if you have everything in the C fund right now and you think you're going to need money in the next 3 to 5 years, yeah, probably now is an okay time to be changing some of that, even though we're not at the top. Okay. Um, Now going into something like the 2030 fund is difficult because with the life cycle funds in the TSP, you don't have a lot of decision-making power on how those things are spread out. You're going to have a lot of money in the G fund, in the L2030 fund. And so having a more custom allocation, or depending on your age, if you're over 59 and a half, you can actually have TSP money moved into an IRA and you can have more leeway on how things are invested there. So that's the thought process, even though we're not be able to give a straight answer to that. That's the thought process. We had another question, another person say, if I still have all my money in the C fund, is it advised to diversify some into bonds and international at this time? As a general rule, I think having some bonds and international in your portfolio, depending on your age, especially, if you're in your 20s, 30s, maybe even 40s, having bonds in your portfolio is kind of up to you. But having all of your equity in the C fund, I think, is always a risk. Evan, Neil, feel free to chip in there, but having some S fund, having some I fund exposure in the equity side, I think absolutely makes sense. And I think, I'd like to hear Neil and Evan, your opinions on that, but I think now is not necessarily a bad time to do that.
I'd say especially now with the run up that we had in the C fund over the last decade, and the price to earnings ratio on that hitting historical levels, when the S fund and I fund are actually properly valued. I think the diversification amongst the C funds arguably makes the most sense over the last 10 years to have that allocated and diversified amongst those three, as opposed to just sitting on that C fund. If kudos to you if you did all C fund over the last decade, but I think we're seeing call it a potential leadership change. I mean, listen, you can't neglect the fact that the C fund holds Microsoft, Apple, Amazon, and all these investments right in there, and those are great funds, but at what price? I'll buy something great, but at what price? And that's the problem with the C fund right now. So again, don't neglect the C. Don't take this advice and say, "Oh, Neil says to not do C fund." It's just definitely get some more S and I in that exposure if you haven't had that in your own account. TSP.
Yeah. Evan, anything there? Or you want to take the next question?
I think we go on to the next question. I think Neil finished it off strong there.
All right, so next question. And this is just, a good general question. What will happen if we go into a recession? Do we know from historical market behavior what will happen if we go into a recession?
Yeah, I
Evan and
mean,
Neil,
Evan, you want
oh, I was going
want
to
to hit
say,
that one?
Neil, I know you and I have talked about this a handful, just even in other market commentaries. Evan, if you had any thoughts on this,
yeah,
first
I
to share
mean,
though.
looking historically, I think there are two good examples. We could look at COVID, and that was a quick recession, but the stock market and world was confused. What's life going to look like in the future when we have a global pandemic? And in that scenario, the whole world adjusted pretty quickly, and we saw the stock market adjust really quickly. So could that happen again? Maybe. Looking back at '08, that's another possibility as well, where could we see a huge correction in the stock market more than we've seen? Could it last a little bit longer for the world to adapt and figure it out going forward? Maybe, but I think that that would be another scenario to look at that could be similar to what could play out in the next couple of years here.
Yeah, Neil, have you done a YouTube video yet on that historical recessions? I know we've done presentations, but I don't know if we have anything on YouTube about that yet. Because we've talked
No,
to we just to give a little sorry, I asked you the question, then I talked over you, but just to give a little historical, like we've done some conversations on this, looking at past recessions and how the market acts in recessions. And typically the relationship is once the market actually typically falls leading up to the announcement of a recession. And then once
mm,
the recession has actually been announced, the market adjusts and actually starts moving forward, even though we're still in the recession, which is really interesting. So the market, we have to think the market always is forward looking 6, 9, 12 months and trying to predict what's going to happen. And so what we typically see is the market falling into the recession, and then once the recession is announced, we actually see the recovery start to happen. But I was asking you the question to
yeah,
see if you knew anything that we could refer people to in terms of a video on our page.
not anything of recent, but we definitely covered it on other market commentaries. But like to your point, most of the time the markets will price in what is that recession going to look like before that recession actually takes place. And then obviously if the recession's way worse and extended, then you can actually see some more market drop during the recession. But on average, 3 to 4 months, once that recession's taken place, the market is actually recovering while the actual economy is struggling for another 16 to 18 months.
Mm,
So you saw that back in '08 and '09, markets dropped in March of '09 was the bottom of the market, and it had a massive recovery starting in March of '09, while the rest of the economy was sliding into late '09, 10, 11. I mean, real estate was still, you still having heightened foreclosures in 2010, all the way up to 11. I believe real estate bottomed in 11 and in most of the areas, and then started to uptick in 11 and go up into 12. I remember that because I bought in 2012, and I wish I bought a little sooner. But point is the market is a forward-looking instrument, which is why it's very difficult to get that right. Whereas the real estate market's a little more easier to figure out because that's a lagging instrument, right? And the pricing on that may start to work its way down way longer and trough way later than the stock market does. So um, yeah, that would be kind of my thoughts around every recession also is different.
mm.
Sometimes the markets have gone down ahead of it. Sometimes it's gone down more in it. In a couple, the markets have actually gone down after it. So they're all mixed. But what I will say is I have a few stats on it. Looking at the last 12 recessions, going back to the Great Recession, out of the 12 recessions, we had one, two, three, four markets that only went down between 20 to 25%. So call it 1/3 was only 20 to 25% drop. Then we had one, two, three recessions that went down in the 30s. Okay. So half, 3 plus 4, we're at 7 out of 12. More than 50% of the recessions was a 20 to 30% drop. Right. And we got down almost 20 in April, in early April, by the way. We were almost at 20. If not, we had touched 20 and it bounced off that 20. So that's what it would feel like for almost half the recessions that have occurred since 1932. Now, the rest of the recessions, right? So we got 7 out of 12 between 20 to 30. The rest of the recessions were 40 to 50% drops, right? But the average duration of those was around 18 months, which means that, we got down 40 to 50. They lasted about 18 months and they were cleared away. So that just gives you kind of a little historical context. I don't have that chart actually right here in front of me, but that's kind of what you would expect if you got a recession, right? And I guess the next follow-up question to that would be, all right, what do we expect if we get a recession? It's too hard to tell, right? How detrimental are these tariffs? Are they slapped back onto the rest of the world, or are we only hyper focused on China? If I'm rolling my dice at the casino right now, I think that the entire game plan was to actually nail China. And they got China to fight back, and now they can essentially say, all right, you're fighting back against us. Now we're gonna zero focus on you. That's where my view is on this. And I think that they've showed their cards in terms of what they're gonna be doing is focusing on China now, which is a major economy, right? And it could still create a lot of disruption. But I think they're going to backpedal away from this world tariff, in my opinion. So
Yeah, and
without going further in a tangent, we can continue the questions.
oh, good. Well, and I just wanted to tag on to that. I saw Constance kind of add in a comment here when we were talking about tariffs the first time, and Neil, since you brought it up there, I figured I'd just tag on or address Constance's comment here, and Constance was just saying, I hear what you're saying about the world adjusting to tariffs, but aren't tariffs just bad all around, right? I mean, the tariffs are bad for everyone, right? So how can we talk about adjusting to them and that being okay? And my answer to that, Constance, is it's not. We have to separate here our role in this, right? It's not our role to define the policy or say what's good or what's not. It's our role to react to it and kind of try to anticipate what's going to happen and try to advise you guys on that. And so I agree with you, Constance. It's like tariffs are not good. It doesn't seem to be doing anybody any favors right now. But do I believe in innovation and in our ability to adjust to whatever happens? I do. So, Constance, I'm not saying, this isn't our endorsement of anything that's happening right now by any means. It's just us, acknowledging that and trying to logically move forward. So then, moving on to the next question here from Joe, is this a good time to buy a fixed indexed annuity? So just a specific question there on a fixed indexed annuity. Just to answer that quickly, Joe, I think that comes back to just like any of the investment discussion here. Where does that fit into your buckets? Like, if you were, let's say, a fixed index annuity can be a good tool for, one of these first two buckets. It's safe, a lot of times guaranteed money. It pays a certain amount over a certain amount of time. We use in our investments, some protected investments, somewhat similar to that. I can't tell you, there's different types of investments that you can use. We use one called structured notes or market linked notes that work similar to that, where you're protected from downside, but you still get some earning potential. So I would say a fixed index annuity can fit into your plan, but it is really dependent on your situation. Neil?
Yeah, I'll chime in. So, we've been doing this for quite a long time. So we've tried many different investments and different investment products, things like that. And I think over the scope of the entire investment package that we offer, our goal as a firm is to move away from the annuity business, and mainly because of the commitment times, right? When you buy an annuity, you're looking at a 5 to 6 year hold at a minimum, a lot of times 10, sometimes 12. And then if you want to get out of that annuity early, you're getting hit with a big penalty, what they call a surrender fee. So to piggyback on Austin's comment there, what we're utilizing now really acts and feels like a fixed index annuity. You invest in an index, typically the S&P 500. You can also invest in another index like EFA, international if you want. But the difference is in a structured investment, which is called a market linked note, which is what we prefer over an annuity, is that the timetable is much more reduced, right? To You could do a year and a half to 3 years. We actually don't go outside of 3 years on these notes, mainly because number one, if you're buying for the protection, maybe you don't need the protection of the full gamut of 10 years. You just need the protection right now during this time frame where the markets are more volatile. Number two, access to your capital. Number three, it's an investment that goes right in your portfolio as opposed to having to reposition this out to a carrier that's an annuity carrier, right? So it's just a lot more flexible. And that's what we're recommending to our clients over any type of annuity products. We know that some clients do have annuity products out there, and those have all, for the most part, in terms of timing, done well for those clients. But as those mature, our new initiative will be to get into smaller time span investments that do the same thing and achieve the same objectives, but gives us more flexibility if we want to keep that investment in that protected vehicle, or we want to release that back to a normal index fund once the clouds clear. Does that make sense?
And I wanted to tie in here. There was another question later on that asked, that was a good clarifying question. It just said, I don't understand when Neil is talking about we are investing in XY. Does this mean Capital Financial Planners has its own funds? Do we invest clients' money, or something like that? Yeah. So for those of you who are not clients of ours already, or who are not as familiar with us, so Capital Financial Planners, does portfolio management work for our clients. We do that on top of, general financial retirement planning, cash flow planning, estate tax planning. But one of our roles is investment management. And so when we're managing somebody's investments, we're doing that through portfolios that are using mutual funds, ETFs, market linked notes, which Neil was just talking about. And so when Neil was talking earlier about, we are defensive with our strategy, or we took some out of our stocks and we included it in a buffered type of investment. That's what we means, right? We don't own our own fund or anything like that, but we are managing people's portfolios. A lot of times that's for people who have, moved money from the TSP into an IRA. Then we're managing that investment for them. So that's what we means when Neil says that before. So that fits well into Neil what you were talking about there with investments. So then let's answer these two questions from Madeline. So Madeline asked, given the unstable tariff policies that seem to swing the market widely, what are your recommendations for the market? Okay, so that's one. And then Madeline also asked, for those of us getting RIFT, with the uncertain future of returning to federal employment, would it be beneficial to roll my TSP funds into another rollover IRA? Is there any real benefit of keeping the funds in the TSP? And I also keep getting TSP advertising messages that are talking about investing in gold. Any thoughts on that? So a couple questions there from Madeline. One is, how do we see tariff policy moving the markets? We've kind of already talked about that. If one of you wants to touch any more on that, okay. But then the other one is the combination of we're getting RIFT, we have the ability to move money from the TSP to an IRA. Is there any benefit of having it in the TSP, or should we do the IRA? And then the question on gold. So Evan, you wanna answer that one?
Yeah, when it comes to the recommendations for the market, that just totally depends on two things: the cash flow needs, when you're going to need the funds, and two, your overall risk tolerance. Those are the two things that would really determine how to move forward there. When it comes to the benefit of rolling it to a IRA versus the TSP, there are different advantages, but I'd say that the biggest one is just the world of investment options open up to you. And one thing that could be beneficial is using the structured notes that Austin and Neil were just talking about, where, hey, I want to be still invested in the market, but I want a little bit of protection if there is a big correction coming in the next couple months or couple years.
Yeah, the TSP, I always put it this way: the TSP is an incredible asset accumulation vehicle. When you are working and you're going to be working for the next 20, 30 years, sticking money in the C fund, S fund, I fund, and watch, just not touching it, forget about it, is a great vehicle for that. The fees, there's really no fees on the TSP. It's extremely inexpensive, right? And so that's really where you get the value from the TSP. It's simple, it's effective, it's inexpensive. Some of the downsides to the TSP come when you reach the distribution phase of life and you want to, one, have more diversification. There's no large growth and large value option in the TSP. It's just the C fund. There's no managed international option. It's just the I fund, right? There's no, and then the other real downside of the TSP is you don't get to choose where your distribution comes from. So say you're 50% C fund, 50% G fund, and the C fund's down 20% this year, and you need a distribution. You don't get to say, hey, I just want to take my money from the G fund, when you'd really like to do that because you don't want to take it from the C fund when it's down 20%. That's the big downside. So I can't tell you, hey, yes, you should move money out of the TSP, but I think those are the pros and cons. And I see when you reach the distribution or near the distribution phase of life, the options available outside the TSP and the flexibility in distributions are two major pulls to having money outside of the TSP in retirement. So that's what I would say,
Yeah.
Madeline. We have a question here on, there's 4 questions left. We'll get to these questions and then we'll wrap it up for today. These have been great, guys. We'll try to do more of this Q&A stuff in the future. Okay, so there's a scenario: an elderly parent has assets in a trust, including a valuable piece of land. When the parent dies, the trust continues to own the land. Is there a step up in basis at that time? Or since the trust owned it all along, is there no step up? Okay, concerned about capital gains. So this is disclosure or disclaimer on this one, right? We're not going to be able to give an exact answer on this because we don't know all the details here. This is really a question for an estate planning attorney or an accountant, but we can give some thoughts. Okay, so Neil, you've kind of gone over a few of these things recently. Any thoughts on this?
Yeah, we just actually went over this for someone's estate plan. So really when it comes down to estate planning and using trust, you have to figure out what the objective is of this person when you're recommending a trust strategy. Is it to avoid estate taxes or is it to get up a step up in basis, right? And so in terms of this potential property, right? The question that we would have is, how was this trust set up? Was it set up as revocable or was it set up as irrevocable, right? Because if it was set up, depending on how those two are are the trust set up, is going to mean whether you get the step up in basis or not.
Typically, a revocable trust will have a step up in basis, while an irrevocable trust will not. And
Yeah.
we're talking typically there. So again, it's all down to how the trust is set up. Trust can be set up a million different ways. So it's impossible to answer this question just knowing it's a trust. But typically, again, a revocable trust will have a step up in basis, and irrevocable would not. So that's what I can give you there. But again, it's going to depend on how the trust was set up. All right. Last three questions. For a mid-career federal employee who might, hopefully not, be part of a RIF in the near future, what, if any, plans or actions would they take to prepare? So just general planning action for somebody who's going to be RIFed. Um, I'll give one. Um, Figure out know what your plan is going to be. Either way, are you going to try to find a new job? Are you going to try to fully retire? Are you going to, depending on your age, that depends, right? So if you're going to find a job, you probably are going to you want to give yourself a grace period where you don't know if that's going to happen right away, right? So the first thing I would do is make sure that you are in an okay standpoint when it comes to liquidity and cash flow. If you are rift and you uh, went an extended period of time with no income, are you going to be okay? So cash flow's really going to drive all this. Now, if you are thinking that that rift could lead to then retirement, you'll also need to think about what that longer term cash flow is going to look like and when you're going to start needing distributions from these different accounts. Right? Each account's going to have different tax and investment implications, whether it's a traditional account, Roth account, non-retirement, just bank account or investment account. So I think it all starts with cash flow, and understanding what you're going to need and when. Uh, Evan, Neil, any other advice for somebody who thinks they could be rift?
Yeah, I think you hit the nail on the head where if it is a more, it's not going to be a full-blown retirement scenario from that point. Really taking a look at the cash on hand and even perhaps lowering your contributions to the TSP to get more cash on hand. Still doing the 5% match because that's a 100% rate of return, getting the match, but that's a consideration as well. And then looking at your expenses too, where hey, this is what I'm spending on a monthly basis. This is what I have on cash. This is how long I'll be able to bridge the gap to find the next job.
Yeah,
Yeah.
and then just from a not specifically financial perspective, understanding what you have earned as a federal employee. So understanding, do you have are you at MRA plus 10? Do you have at least 5 years? Have you earned a deferred pension, or a delayed pension? Understanding what benefits are available to you. Are you eligible to continue your health care? Right, depending on your years of service and your age, and what's available at the time with your agency, all those things kind of hinge on that. So having a really good understanding of the benefits that are going to be available to you or not, and then understanding your cash flow. I think those are the two biggest things if you see that potentially in your future.
And one thing I wanted to chime in on, going back to the last question on that trust, is first of all, the question was, am I gonna get a step up in basis? I just wanted to define what that is for the rest of the audience listening.
Mm.
This person was asking that this inherited piece of property or land that they are inheriting, would the cost basis step up from the original cost basis of what the land was purchased for versus what it is worth now? Would it get stepped up in basis to what it's worth now? That's what a step up in basis is. And typically that's what happens. Folks get a step up in basis when they pass away. That means their heir gets a step up in basis when it changes hands. Now, joint properties don't get a step up in basis. So that's one thing to consider. When you own your property outright, jointly, and you pass away, your property doesn't change hands. It just goes to the next person, right? So you don't get a step up in basis. But if you own something individually and then someone inherits it, the law states that that person gets a step up in basis. Now, there are trusts that can avoid the step up in basis, which is detrimental because those trusts are written for a different beneficial outcome, which is avoiding estate taxes. And what you had mentioned, Austin, was that revocable trusts generally get a step up in basis, which is true. And the majority of trusts that are written are revocable, right? I write that and I can change the trust, which means I still have powers over that trust to change the income distribution, to change the beneficiaries. Therefore, it's revocable. And therefore, those assets are still kept in my estate. And when they're kept in my estate, my beneficiaries get a step up in basis. But when those assets are not kept in my estate, right, then my beneficiaries lose the step up in basis, but they gain not getting an estate tax associated with that. Now, estate tax thresholds are super high. They're like, what is it, $12 million per individual? So a lot of people aren't trying to avoid estate tax. You would want to avoid losing your step up in basis. The one thing I will say to add to that is irrevocable trusts where the grantor retains control in some fashion, like income or use of the property, right? That would still be deemed included in their estate because they kept some sort of control, whether it was the income generated off the land or property, maybe they were using it for farming, and they were receiving that income, not other beneficiaries were, or they were using it, right? Lived in that property or lived on the land, right? That would still be included in their estate, even though it was in their revocable trust. That would still get you the step up in basis. So just wanted to add a little more color to that because that is something that we're pretty passionate about, is talking about estate planning, right? We're adding more of that to what we're doing for clients. We actually have advanced estate planning in some of the cases that we're doing for some of our clients. So those are conversations that can be had with any one of our individual clients or prospective clients as well.
Just one thing to piggyback off that is what's the benefit of the step up in basis? Let's say your parents paid 100,000 for a property, and then when they pass, it's now worth 1.1 million. The step up in basis is now it's worth 1.1 million to you. If there was no step up in basis, you would have to pay capital gains tax on that million of growth. So you'd owe almost 200,000 in taxes. So the step up in basis is a huge benefit.
Yeah. Which is why you don't want to lose the step up in basis by having an estate plan that has a trust that loses the step up in basis. Right.
Yep.
So
And
answer to
and
that
this is just sorry, Neil, I didn't mean to talk over you there. I was just gonna say this is in the past 10 years or so, the estate tax rules have changed dramatically. So if there's a family trust or something, or your parents have a trust, or you have a trust even from 10, 15, 20 years ago, get it checked out, because the
Yeah,
things you were trying to protect yourself then may not be important anymore, right? And
100%.
everything, the reason a lot of these trusts were built was to protect against estate taxes, which are now, there's huge exemptions on those, like Neil said, like $12 million a person. So it's not nearly the issue that it used to be, and you could be
And
depriving your beneficiaries of other benefits because you're trying to protect against something that isn't an issue anymore. Um,
exactly. Back in the
so
90s, the state tax threshold was $1 million. So of course,
yeah,
everybody was trying to protect against estate and inheritance taxes because you were having over $1 million of assets at the end of your life. But now with that set at $12 million, you're not really trying to protect for estate taxes. You're trying to protect the step up in basis and other things that you're doing. So correct. You got to get that double checked out, especially if you have elderly parents that are still around, that may have told you they set up a trust. Double check that out to make sure that you're not losing benefits by protecting things that aren't necessary.
yeah.
And also
All
the
right.
alternative is true with these huge brackets and exemptions where maybe it makes sense to get it out of your name now, get it out of your estate now while there's these huge exemptions.
Yeah.
Yeah. Yeah. All right. Let's get these last two questions answered. People, thank you for those of you who stuck on. This has been a good long call. We've gotten a lot of questions answered. We got two more left here. All right. So we had I have a TSP slightly diversified among some funds. However, I'm looking a bit more into diversify. Sorry. I'm looking to diversify a bit more with purchasing some housing property, so some real estate. Is that a good idea with all the uncertainty and instability? So is mixing real estate into your investment mix a good idea with everything going on right now? Evan, I know you got a couple rental properties. How do you feel about diversifying with real estate?
Yeah, I think it just totally depends on a couple of things. Um, Generally speaking, is it good to diversify with the housing property? Yes. Not making up a huge portion of your net worth, but to have a little bit of your overall net worth being diversified into the real estate market, sure. But I do think it depends on the property as well, where it's possible to find some properties that are less risky versus more risky, being in a more stable market versus gambling on, oh, I think this market is gonna boom. I'm gonna invest in a house here and have it go the opposite way. So depends on a couple of things. Could be a good idea. Depends on the property, and I wouldn't make it a huge part of the portfolio too. What are your thoughts?
Yeah, I think it really depends. There's a lot of different ways to invest in real estate. You can own a property, you can invest in a real estate fund that's then completely hands off. I think one thing to note about investing in real estate is there's a lot of people on social media, there's a lot of news, a lot of things that make real estate seem like this amazing passive investment where all you do is collect a paycheck. Um, I know actually all three of us own rental property, and even if you have investment managers or property managers on it, it's never completely hands off. So
Yeah.
understand if it's going to be a good fit for your lifestyle to own a property, and know it's not going to be something that you just get to ignore. But sure, investing in real estate, even through a fund or something like that, can be a good diversifier. I don't think it needs to really be included in a portfolio until you get up to higher values in that portfolio. But Neil, what are your thoughts?
Um, and this actually knocks two questions off. Um, the in terms of answering this is the way that this person stated this and the way that another person stated about advertisements on gold. I've had this
Mm,
come up in meetings in the past where it's like, hey, should I take money out of my thrift savings plan and buy real estate and buy gold? Well, if that's what you're thinking, absolutely not, because you would be taking money out of a pre-tax plan, taking it out of a retirement plan
mm,
generally, and just buying real estate that's going to be taxable gains and things like that. or in these advertisements for buying gold bars and stuff like that, I've literally had people make the decision to take money out, pay the tax, and buy gold bars. No, awful decision, right? Now, if we're talking about diversifying your TSP more, I feel that, and I would agree to that. But there's way better ways to do that and keep your money inside of the retirement vehicle that it is in currently, as opposed to sending that money out, taxing yourself, and buying whatever it is that you're looking to buy. And that could be through different indexes outside in an outside IRA. You could even look at REITs. You can look at gold inside retirement plans, but just never take it out of that confines of a retirement plan to invest in these other alternative investments, and pay the tax to buy those investments.
Great catch, Neil, on that, on
Yeah.
taking money out of the TSP. That's a really good point there.
Yeah.
And then the last question we have here is on Roth conversions. So this is something we talk about a lot. We didn't really dive into it today, but one of our favorite tax strategies right now is taking money from traditional accounts, moving it to Roth to take advantage of the tax environment that we have under the Tax Cuts and Jobs Act, as well as prevent what we sometimes see and with what we call a tax bomb that can happen in your late 70s when your mid to late 70s when your required minimum distributions start. So the question was, how aggressive should one convert his or her traditional IRA to a Roth over the next 4 years? How aggressive should you be in moving that traditional money to Roth? So like most of the questions here, so this somewhat depends on your situation, but I would say the general idea here is right now the 22% and 24% tax brackets are really generous. Okay. As a couple, you can make almost $400,000 and still pay a 24% tax rate. It used to be around 280,000, 300,000, where you went into 30% plus tax rates as a couple. So we see that 22 to 24% bracket for most people is kind of a sweet spot. If you're converting within that realm, you're probably not making a mistake there. Okay. Now, grain of salt here on that. That is not the case if you are going to retire. You're just going to live off your pension. You don't really have a lot of traditional money and you're going to be in the 12, 15% bracket, right? That's not probably most people on this call, but there are situations where being aggressive with Roth conversions are not a good idea. Okay. But the 22, 24% bracket typically look like a sweet spot. Now, additionally, it's looking like the Tax Cuts and Jobs Act is likely to be extended. As it's currently written into law, nothing has changed. As it's currently written into law, the Tax Cuts and Jobs Act expires at the end of this year, and our tax rates revert back to where they were in 2017 next year. We still have half the year yet. There's for sure to be some debate on this before the end of the year. But we think with the administration that's in place, it's likely that we have an extension to the Tax Cuts and Jobs Act, which means the urgency isn't quite as high as what it might have been if we thought that was going to sunset next year, right? So how aggressive should you be? Well, that's all relative. But our view is, if you're staying within that 22 or 24% bracket, you're probably not messing up too bad. But that's something that we obviously would talk about in a checkup or a more in-depth financial planning session. Neil, Evan, any thoughts on that?
Yeah, I think if we saw that the tax brackets were not going to be extended, we'd be a little bit more aggressive. But because that we see it being extended, we don't need to be aggressive. That being said, I think it's a good idea to be efficient every single year and strategically filling up a tax bracket on purpose, looking at your future AGI and income down the line of retirement. So taking advantage of these tax brackets that we have and being efficient every year makes a lot of sense.
Yeah.
Yeah.
And when markets are down, it's the best time to do it.
Yeah.
So,
Yep.
so, you know, I just had a meeting with a client yesterday. Um, they did a $75,000 Roth conversion last year. We're moving to a $135,000 conversion this year. And we're basically double down, double,
Doubling
double
down.
down, doubling down on the conversion. Mainly because, you know, she's gonna be hitting the age of 65. Medicare premium brackets start coming into play there here soon, so might as well get the bigger conversions out of the way with the market down. But in a Roth conversion scenario like that, where you're doing a big one, I'd recommend topping that up maybe over the course of the year and doing two. And maybe not doing all one big one right now, but take advantage of the market being down and then maybe look to doing another one later in the year.
Yep. Good thought. Wow, guys, that was an hour worth of Q&A. Thank you everyone for sticking on
Yeah,
and asking great questions. I think that's going to be really helpful to people who eventually watch this on YouTube as well. If you've got a question here, I guarantee other people have it as well. So thank you all
yeah.
for sticking on with us. We'll do this again in the future. We're going to try to stick to monthly market commentary as well. The market's being choppy. I know we kind of switched to every other month for a while. We're going to be back at once a month here for the time being. So we keep getting in front of you guys. And yeah, Evan, Neil, anything to add before we wrap up today?
Is baby Kennedy gonna make a guest appearance? I'm sure everyone's wondering.
Thinking about it, I know she's sleeping right now. I think the better way to do it is to send out pictures. So we'll send out some pictures over email. Not everyone also is a current client that has a personal relationship with us as much as others. So I think it's more appropriate to do it on that part. So I'll be
That
getting
makes
some
sense.
pictures together and we'll get an email out to our clients that are looking to see some pics.
All right.
Sounds
Sounds
good.
good. Well, thanks, guys. Thanks, everybody, for sticking on, and we'll see you all soon.
All
Bye,
right.
everyone.
Thanks, guys. Appreciate it.